is heading into troubled waters, with recession now a clear and present danger in 2020. Warning lights have been flashing for a while now due to trade tensions, currency movements, corporate debt, and a no-deal Brexit. But policymakers seem largely unprepared for the storm ahead. Global growth in 2019 was the slowest since the financial crisis of 2008-2009, with the world's GDP rising roughly by just 2.2%. This year is expected to be a little better, with the global economy growing by 2.4% in 2020. Rich economies are expected to continue to experience lackluster growth rate, just like in 2019. And the world will continue to see a slowdown in manufacturing that will also drag down growth worldwide. The only good news seems to be that Asia's GDP will overtake the GDP of the rest of the world combined in 2020. In today's In-Depth, we will take a look at the latest Global Economic Prospects report of the World Bank, how Asia will be the bright spot in world economy, and what the relation between growth rate and a nation's debt is. The World Bank recently released its Global Economic Prospects report, where it projected global growth at 2.5% in 2020, which is just above the post-2008 crisis low registered last year. Meanwhile, a steep productivity growth slowdown has been underway in emerging and developing economies since the global financial crisis, despite the largest, fastest, and most broad-based accumulation of debt since the 1970s. More details in this report.
Global economic growth is likely to pick up slowly this year and next, though the recovery will be more modest than previously estimated despite the easing of trade tensions. In the World Bank's latest Global Economic Prospects report, the expansion will accelerate marginally to 2.5% this year from a 2.4% pace in 2019. Largely because of stabilization across a handful of large emerging economies. The report further says that the global trade growth is also expected to improve modestly in 2020 to 1.9% from 1.4% in 2019, which was the lowest since the 2008-2009 financial crisis.
The World Bank has shown a slight optimism. It says there was an upward trend, but it's a very fragile path. You see, this trend can go on, consolidate itself, but the World Bank fears that there is a high unpredictability in trade policies and other financial policies. Therefore, the World Bank feels that this trend can continue provided we have more predictability in policies and more governments get together to find out the solutions for this issue.
Advanced economies, emerging markets and developing economies all show divergent prospects in the World Bank forecast. The US economy is projected to grow just 1.8% after 2.3% growth in 2019. China's GDP will expand by less than 6% for the first time since 1990, with an expected 5.9% growth rate. In the euro area, the expansion is set to slow further to just 1.0% this year before picking up in 2021. Japan's economy will continue to slow with growth of just 0.7% expected in 2020 as it continues to experience a weak manufacturing and exports.
Secondly, the World Bank also comes forward a little positively for low-income countries. They say for the last 25 years, the low-income countries have maintained a very low rate of inflation. There is a lot of stability in their economies. But it now worries whether the unpredictability in the international arena will bring about pressures on these low-income countries where most of the poor people of the world live and upset the stable economies that they have. So there is both positive aspects in the World Bank report, and also there is a degree of uncertainty because it feels that the policies in the last year or 2 years have not been very stable. So there is both good and bad in the World Bank outlook.
The World Bank also says that the much of the emerging market improvement is driven by 8 countries. Argentina and Iran are expected to emerge from recession in 2020. And prospects are expected to improve for 6 countries that somewhat struggled in 2019: Brazil, India, Mexico, Russia, Saudi Arabia and Turkey. Argentina, which contracted 3.1% in 2019, is projected to slow by 1.9% this year, while Brazil and Mexico should expand by 2.0% and 1.2% respectively, far faster than last year. In the sub-Saharan Africa, the news is looking up with a solid increase in GDP growth expected this year. The Middle East is expected to see growth jump to 2.4% this year after virtually no growth in 2019.
Particularly well, almost every country. In fact, even with this current rate of growth, we are the second, among the major economies, we are the second fastest. In fact, we were the fastest till recently. And by 22-23, by the year FY22, we will again be the fastest growing economy. So, in terms of world, India is one of the fastest growing economy. The rest of the world is hardly growing. So, in context with the rest of the world, it's big, but the fact is that the Indian economy compared to its previous growth rate has come down, and that is causing a problem for everybody around.
The Multilateral Development Bank has also cut India's growth for financial year 2020. It expects the country's growth to recover only slightly to 5.8% in the next financial year. The report underlines record high debt levels and fragile public finance positions, leaving many countries vulnerable to shocks or a sudden increase in interest rates. An extensive look at productivity trends in this edition of the Global Economic Prospects focuses on how the productivity slowdown has affected emerging and developing economies. Average output per worker in emerging and developing economies is less than 1/5 that of a worker in an advanced economy, and in low-income economies that figure drops to 2%. While the Global Economic Outlook for 2020 envisions a fragile upward path, there is high degree of uncertainty around the forecast given unpredictability around trade and other policies. With inputs from Vipul Agarwal, Bureau Report, Rajya Sabha TV.
Growth in developing Asia is moderating but remains robust. Asia has become bigger, richer and more connected since 2010, a reflection of the eastward shift in the world's economic center of gravity. According to a recent World Economic Forum report, Asia's GDP will overtake the GDP of the rest of the world combined in 2020.
Home to roughly 60% of the world's population, Asia is the largest of the world's continents, covering approximately 30% of the planet's land area. The continent is home to the world's top economies, China, Japan, and India. In terms of the gross domestic product, the combined GDP of China, Japan, and India was $21 trillion in the year 2018, which was a notch above the US, which stood at the top at $20.5 trillion. According to the World Economic Forum, in 2020, Asia's GDP will overtake the GDP of the rest of the world combined. By 2030, the region is expected to contribute roughly 60% of global growth. Asia Pacific will also be responsible for 90% of the 2.4 billion new members of the middle class entering the global economy. The bulk of that growth will come from the developing markets of China, India, and throughout Southeast Asia.
Asia, as most of the emerging economies, they're very adaptable. They're able to take problems worldwide in the economies. If there's any setback, they're able to adjust and go forward. So towards this end, we find that even though advanced countries, the rate of growth has fallen and there are certain problems there, the emerging economies, most of which are in Asia, have been able to weather this. Their rates of growth are high. So we can see that in the next 2-3 years, that the emerging economies, especially in Asia, will go ahead and weather the storms of the last year, 2 years, all the trade policies, because they have been able to factor in many of the problems. And also, whenever there is a sharp decline, whenever there are a kind of recessions in the economy, after some time, economies recover. Unlike low-income countries, emerging economies in Asia and most of the Asian economies are viable enough and strong enough to take advantage.
While these estimates predict massive growth, the patterns will vary across markets depending on local demographics, politics, and other macro factors. Countries will have to overcome some serious challenges to continue the economic growth. China, for example, has identified targeted poverty reduction, effective control of financial risks, and improvement in the environment as 3 tough battles for the year 2020. Given the changing face of China's relationship with the rest of the world, the road ahead is going to be tough. A big challenge will be the ongoing trade war with the US that began in 2018 and is unlikely to ease anytime soon. On the economic front, India too is going through a challenging phase, with the annual growth rate predicted to be low owing to high unemployment and a slowdown in the rural agricultural sector. But the government is taking several measures to respond to these challenges, stimulate economic growth, and generate employment and income. In its latest report, the World Bank has left its growth forecast for Japan unchanged at 0.7%, but it says that the economic activity declined sharply due to conditions in the wake of typhoons and the consumption tax hike late last year.
I mean, if you look at any growth recovery, any estimate of which are the major growing countries, you find they're all in Asia: India, China, our neighbor Bangladesh, a bit further off countries like South Korea, Indonesia, Malaysia. These are the big powerhouses. You don't hear of Europe or any other Latin America leading the growth rate. So definitely it's Asia.
After the financial crisis of 2008, Asian economies emerged as the world's growth engine in the last decade. While advanced economies struggled with growth in the low single digits for much of the 2010s, China started out with a sizzling 10.6% growth and was still clocking a respectable 5% plus by the decade's end. It was a similar picture in India as well, which is Asia's third largest economy. Decades of rapid growth have transformed developing Asia from a low-income region to a middle-income one. Innovation, human capital, and infrastructure are the 3 pillars of productivity growth, which will take Asia to the high-income group now. With supportive institutions, policies, and macroeconomic stability further strengthening these 3 pillars. Even as the World Bank has painted a weaker outlook for global growth in 2020, and despite several challenges in the region, Asia's dynamic track record suggests the growth status is achievable. Bureau Report, Rajya Sabha TV.
With this, we'll halt in for a quick break, but we'll be back soon. Stay tuned with us. Are responsible for slow growth. Debt distress seems to be the biggest threat to international stability right now. As per a recent report, global debt hit a record high of over $250 trillion in 2019. In this report, let's try and understand how the build-up of debt affects economic growth of countries.
The world economy is heading into troubled waters. Recession in 2020 is now a clear and present danger, according to UNCTAD's Trade and Development Report 2019. The report says there are enough warning lights flashing around trade tensions, currency movements, corporate debt, Brexit, inverted yield curves, and negative interest rates. But there is very little sign that policymakers are prepared for the storm ahead. The slowdown in growth in all the major developed economies has affirmed that relying on easy monetary policy and asset price rises to stimulate demand produces, while tax cuts for corporations and wealthy individuals have failed to trigger productive investment.
See, most of the countries which are facing economic turbulence, most of their financial institutions have given too much money. They're in a very bad state. So naturally they can't give you more debt. Unless there is debt, unless there's credit available to industry and to individuals, there cannot be demand, and manufacturing will not be very, very strong. So now, as in India you saw, most of the banks had very serious stress, but the government had taken some steps in the last 5 years to reduce the stress in banks, to reduce the amount of bad debts and clean up the banks. So naturally we expect our banks in India to give more credit and be more helpful to industry and trade. So this situation is prevalent all around the world. When the economy has come back and slowed down, naturally the payments to the banks were not there and there were bad debts. So definitely when there are a lot of bad debts, there will be less credit for industry and the economy will suffer.
As economic worries mount in the advanced economies, the developing regions such as Southern Africa, Latin America, South and West Asia also face growth deceleration. These weaknesses are emerging in the context of a significant build-up of debt across the developing world, much of it short-term and denominated in foreign currencies, with the biggest increases in the private sector. By 2017, total developing country debt had reached its highest level on record at 190% of its GDP. This mainly composed of private sector debt, which rose from 79% of the GDP in 2008 to 139% in 2017. The increase in private debt since the financial crisis has been particularly sharp in high-income countries, reaching 165% of their GDPs in 2017, although the trend is also visible in low-income countries.
Doing the reforms or doing the economic policies correctly and sticking on to them is important. For instance, one of the things that we have to ensure is, let's take the example of commerce, retail sector. In retail sector, there's a lot of call from the smaller retail firms or shops to not allow private sector, to not allow foreign direct investment to come in. But the investment by foreign direct, the foreign direct investment that has come in the shape of the big companies like Walmart or Amazon, it has created a huge tertiary benefit. Look at the building of warehouses that's happening. In fact, even in the NCR region, if you look at the number of logistics chain centers which are coming up, they're not coming up abroad, they're coming up in India. And those chains coming up there is obviously providing income to the people there. The number of boys and girls who are getting employed there is phenomenal, and they're getting better quality employment. So all of these things are necessary to ensure that the economy takes off.
Countries usually see growth slowing down when their debt levels reach 90% of the gross domestic product. The median growth rate falls by 1% and average growth falls even more. Research suggests the same slowdown occurs for advanced as well as emerging countries, although the latter is also vulnerable when their external debts reach 60% of their GDP. The debt level in emerging economies is associated with a decline in growth rates of about 2%. At higher ratios, growth is cut by about half. Inflation also rises sharply as emerging nations' debts increase. A big difference between advanced and emerging nations is the correlation between debt levels and inflation. For advanced nations, median inflation typically falls as debt grows. For emerging nations, however, median inflation doubles as debt grows. As per research, fiscal dominance is a plausible interpretation of this pattern for emerging economies. For emerging nations, external debts also represent pitfall. Above external debts of 60% of the GDP, growth rates for emerging nations dropped sharply between 1970 and 2009. Above 90% of GDP, median growth plummeted further and average growth actually turned negative. The maturity of the debt also plays a factor, with nations heavily reliant on short-term borrowings most vulnerable to sudden crises. Countries face thresholds for debt and GDP above which the growth impacts may increase non-linearly. A global economic downturn can push many countries into debt distress. In this context, there is need for debt relief and restructuring if sustainable development is to be achieved in the coming decade. With inputs from Vipul Agarwal, Bureau Report, Rajya Sabha TV.
So that's it from us today in In-Depth. We'll be back same time tomorrow with a focus on another key subject. You can